You might be asking yourself, why in the world did the market get hit in the nutsack today? Dow falls nearly 300 points as banking sector concerns weak China data overhang. Regional banks slide after Fed's Kashkari advocates significantly further capital regulation. So you're thinking to yourself, okay, we've been battling inflation. We know what's going on with regional banks. We're getting weak numbers out of China. There's no way it got worse. Oh yeah, no. It 100% did. Fitch warns it may be forced to downgrade dozens of banks, including JP Morgan Chase. And that's notable because it's literally the biggest bank in the entire world. Fitch Ratings cut its assessment of the banking industry's health in June, a move that analyst Chris Wolf said went largely unnoticed because it didn't trigger downgrades on banks. So the argument here is if you have a large bank operating in an economy that doesn't have the maximum credit worthiness, like the AAA rating, if it gets downgraded to AA-, inherently that means that the largest bank itself can't have that maximum rating. But another one-notch downgrade of the industry score from AA- to A+ would force Fitch to reevaluate ratings on each of more than 70 US banks it covers. In this situation, we have weak numbers coming out of China. The consumer over there, very, very weak. Within the US, obviously, we've been battling inflation. We know what recently, a couple months ago, went on with regional banks where we had some of the biggest blow-ups in US history. And then all of a sudden, you add in the downgrade of Moody's of the US creditworthiness as like the government, not an individual bank. And then that rolls into this situation where Fitch is saying, we might have to downgrade some of the biggest banks. It's just a really, really bad mixture right now. So when all of this was coming on and it all kind of came in together, because obviously when it rains, it pours, that's exactly why you get a day that looks like today when the market just got absolutely rocked. We had a bit of a recovery yesterday, Monday, August 14th. But today, Tuesday, we made a fresh low. In fact, we haven't been at this level since mid-July. So basically, we're giving back a month's worth of action. If you're asking me, I don't have a crystal ball. My crystal ball is out being repaired right now. So this is just one man's opinion. 50% of the time, I'm right 100% of the time. If we don't quickly recover above this level, the next major zone of report is going to be just below 440 as we're trading at 442.43. So that's what I'll be looking for. But yes, we broke the start of the week's low Monday. We broke last week's low, the low from Friday, and I'm not seeing any buyers step in right now. You could argue from an economic standpoint, there's good reason for it. Once again, weak, inflationary impact or weakness across the board because of inflationary impact in the US. And right now, the newest way that it's showcasing itself is the fact that we're seeing downgrade. Well, we did see a major one from Moody's, and we now might be seeing additional ones from Fitch, and the FOMC members or Fed members are not making this situation better whatsoever. So that's the situation for right now. In the very short term, I'm looking for the bears to finally have a little bit of a win here because the bulls have been winning from March. I'm not calling for doomsday. I think it's silly to call for doomsday, but right now it's hard to really be a bull in the short term. If you're a swing trader or a day trader, be careful catching a knife because that's a perfect way to get stabbed.